20% of the world's crude oil supply just vanished from the market. That is an event 3 to 5 times larger than the famous oil shocks of the 1970s and 1990s. This is no longer a small flare-up. It is fundamentally altering the global economy. We are going to start with the bearish news shaking the markets this week. The conflict in the Middle East has escalated into an economic battle targeting energy infrastructure. The closure of the Strait of Hormuz is creating massive supply chain disruptions. As a result, Brent crude oil prices have soared above $115 per barrel. That marks a 60% increase since the end of February. But the problem extends far beyond the price of oil. Iranian retaliatory strikes caused extensive damage to Qatar's Ras Laffan industrial complex, which is one of the world's largest suppliers of seaborne liquefied natural gas. Analysts estimate these facilities will require 3 to 5 years for full repair. Because of this sudden shortage, European wholesale gas prices have already doubled. Welcome to Coffee Break Capital. Financial markets move fast, but we move faster. Sit down, take a sip, and let's get you caught up on the numbers that matter today. This energy shock bleeds directly into our global food supply. The Middle East provides approximately 50% of global exports of urea and sulfur, which are critical for fertilizers. With the rising cost of these petroleum byproducts, experts expect crop yields to suffer and food prices to jump globally. Whenever an energy supply shock hits this fast, history shows that inflation becomes incredibly sticky. This leads us right to the monetary gridlock at the Federal Reserve. Following their March 17th to 18th meeting, the committee decided to hold the federal funds rate at a target range of 3.50% to 3.75%. While this was widely expected by professionals, their updated outlook was a harsh reality check. Due to the Middle East crisis, the Fed significantly upgraded its inflation forecast. They now expect the Personal Consumption Expenditures Price Index to reach 2.7% by the end of 2026. Furthermore, their projections signal only 1/4 point rate cut for all of 2026. Before we shift gears to the bullish news that is keeping the market afloat, if you want to stay ahead of these rapid market shifts, take a second to subscribe to the channel. We break down these complex macroeconomic moves every single week so you are never caught off guard. Now, let's look at the bullish stories and where the money is actually flowing. Investors are rapidly rotating into real economy sectors that generate tangible goods and services. They view these areas as less vulnerable to geopolitical shocks. Energy companies, supported by strong free cash flows, are seeing strong capital inflows. In fact, energy stocks surged 25% to start the year. We are also seeing a dramatic restructuring of the consumer staples sector. On March 20th, Unilever confirmed it is in advanced discussions to sell its global foods business to McCormick. This division holds iconic brands like Hellmann's and Knorr, with an estimated equity value of roughly $33 billion. For McCormick, a company with a market cap of $14.5 billion, this would be the largest deal in its 137-year history. It would transform them into a global condiment and flavoring powerhouse. Meanwhile, in the banking and technology sectors, artificial intelligence is evolving. The banking industry is moving toward agentic systems with actual transactional authority. Goldman Sachs is developing autonomous agents to handle core trade accounting and client onboarding. Lloyds Banking Group expects this agentic AI to add £100 million in value this year by automating complex fraud investigations. And then we have the ultimate retail wildcard, GameStop. CEO Ryan Cohen is shifting the company narrative from a struggling retailer to a tech-focused holding company. They have built a massive war chest of approximately $8.8 billion in cash and marketable securities. They have also integrated a tactical $500 million Bitcoin reserve into their treasury strategy. Speculation is incredibly high that they will deploy this liquidity into a transformative acquisition in the consumer tech or fintech space. Looking ahead to our market predictions, the week of March 23rd is heavily weighted with macroeconomic data. Investors should anticipate major volatility around a few key events. On Tuesday, March 24th, global Flash PMI data will be released. Every PMI tracked by Bloomberg is anticipated to show a decline, offering the first real look at the economic damage from the Middle East conflict. On Friday, March 27th, The US will release its final estimate for fourth quarter 2025 GDP growth. The second estimate showed a sluggish 0.7% growth rate, significantly lower than the 4.4% seen in the third quarter. Here is your safe takeaway for the week. The market is splitting between those who can absorb energy inflation and those who cannot. Review your portfolio's exposure to rising energy and borrowing costs, and look toward companies with strong balance sheets and tangible assets. This information was compiled from various sources across the internet and is not intended as financial advice.